Elroy Dimson famously said, risk means more things can happen than will happen.
That's a great quote to start with.
Right. And today we're taking a deep dive into the Capital Alphabet 2024 annual letter. Our mission really is to unpack their unique insights on navigating the market we saw in 2024.
Which was quite a market.
Exactly. Especially that whole Magnificent Seven phenomenon. And we want to look at their disciplined path, maybe see what it means for you long term.
Yeah, this letter, it offers a really clear disciplined perspective. It's about smart investing, which is so important with all the, volatility and just the sheer amount of information out there.
Okay, so let's set the scene a bit. The market snapshot. The S&P 500, it soared, about 25% in 2024?
Roughly, yeah. A huge year.
And a lot of that was driven by the Magnificent Seven, as everyone calls them: Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla.
The big names.
Yeah. I mean, it was one of the strongest two-year runs since, the late 90s, right?
It really was. And against that backdrop, you have Capital Alphabet expressing this distinct unease, that's the word they use.
Unease.
About the valuations.
Exactly. With the lofty valuations of those stocks, they see a substantial speculative component there. And what's really key, I think, is their preference for over-conservatism. They're not buying into any new era thinking.
Okay, so over-conservatism, how does that actually play out in their philosophy?
Well, it means their main goal isn't just to beat the market when it's rocketing up.
Right.
It's long-term outperformance, sure, but they expect to really shine in, say, stable or declining markets.
Okay, so outperform when things are tough or sideways?
Yeah, and maybe perform just at or slightly below average when markets surge.
That's fascinating. They even give that example, don't they? Like, if 15% portfolio drop is far superior if the market's down 30%.
They do. It really challenges how most people think about performance, doesn't it?
It absolutely does. Yeah. It's all about avoiding those big losses. Strategic defense, you could say.
Yeah.
Precisely. It highlights how compounding really works. Protecting capital is just as crucial as growing it.
So with that philosophy, how did they actually do in 2024, especially since they weren't riding that MG7 wave?
Well, get this. They reported a net gain of 26.57% for 2024.
Wow, okay. Over 26%.
Yeah. And achieved without relying heavily on those high-flying Magnificent Seven stocks.
That really underscores their approach.
It does. And look at the cumulative picture. Since they started in June 2022, if you put in $100,000, it would have grown to about $211,920 with Capital Alphabet.
Okay, over double.
Compared to the S&P 500, where that same $100,000 would be around $147,040.
That's a pretty significant difference.
It really is. Which brings us to the obvious question. How? What's their actual method?
Right. Their method of operation, as they call it. They break it down, don't they? Two main categories.
That's right. First, you have generally undervalued securities.
What are they looking for there?
The basics, really, but done well. A good and understandable business, high return on capital employed, meaning it makes good money on the money it invests.
Got it.
Run by trusted management, and crucially, bought with a good margin of safety. Buying it cheap enough to have a cushion.
Standard value investing principles, but rigorously applied. And the second category.
That's workouts. These are more event-driven.
Like mergers or spin-offs.
Exactly. Situations where the result depends more on specific corporate actions happening. Mergers, liquidations, reorganizations, that sort of thing.
Interesting. So a mix of long-term value and special situations.
And they're also refreshingly candid about, their limitations and mistakes.
Yeah, I saw that. They talked about bottom performers.
They did. Like Gear Energy, a tough lesson, apparently, in commodity investments. Volatile stuff.
Right. And wasn't there another one, SIRI, Sirius XM?
Yes, a new purchase. It actually dragged down the 2024 results by about 3%, they said, but they still see potential there.
Which led to that quote.
Yeah.
Something about flowers and weeds.
Yeah. Hope we didn't cut flowers and waste the weeds. It speaks volumes about patience, right? Not selling just because something's down short term.
Absolutely. Resisting that urge.
Yeah.
But they had big winners, too.
Oh, definitely. Over the fund's life, they mentioned Naspers that contributed almost 40% attribution.
Wow.
Bank of America, nearly 39%. Even Meta, almost 17%.
So despite maybe missing some G7 upside recently, they've clearly benefited from some of those names over time.
Absolutely. And their conclusion from looking at winners and losers, pretty simple.
What's that?
Basically, repeat whatever works for us, learn, adapt, but stick to what generates value.
Keep doing what works. Makes sense. So what really holds all this together? What's the guiding star?
It seems to be that relentless focus on maximizing long-term portfolio value. That's the ultimate goal.
And that encourages prudence.
Right.
Avoids chasing fads.
Totally. It's not about chasing the latest hot trend or just trying to gather assets. It's a deep commitment to their specific value approach.
And that commitment, it feels really personal. The manager actually says, all my retirement savings are invested in this fund.
Yeah, that's huge. Talk about skin in the game.
And they plan to keep it there for, what, 25 years? That's truly eating our own cooking.
It really is. And you can see how that level of personal stake reinforces everything else. The conservatism, the long-term view. You're not going to gamble with your own retirement savings.
No kidding. It forces that prudence.
Yeah.
And it links to who they want as partners, too.
Definitely. They mentioned the fund's assets were about $1.6 million starting 2025, and they're thinking about raising the minimum investment for new partners.
Why? To ensure alignment.
Seems like it. They explicitly say they want investors aligned with our goals, strategy, risk tolerance. They're not just looking for anyone's money.
Right. Transparency and alignment are key.
Mm-hmm.
So, wrapping this up, thinking about this whole Capital Alphabet letter, what's the one thing, maybe an unexpected insight or principle that really stands out to you?
For me, it's just how powerfully it shows that a disciplined, patient, value-driven approach can work.
Yeah.
Even when it means going against the herd, like with the Magnificent Seven recently, it truly differentiates them in these, well, sometimes irrational markets.
Yeah, discipline and patience.
Yeah.
And maybe for you, the listener, consider how that philosophy of over-conservatism and that really deep personal commitment, how might that apply to how you assess information, how you make important decisions, not just in investing, but, in your own world? Something to think about.